loss ratio. Now, when you're actually demonstrating the example, you're going to use 3 years to at least demonstrate the example that the losses from the previous year are going to affect this year, and that's the reason why the rates increase. So usually what I do is I use the last 2 years and obviously the year that we're in. So in this case, we're in 2019, so I would use 2017 and 2018. Now the example that I use is simply losses of $1 million for 2017, and I emphasize that in 2018, the losses went from $1 million to $3 million. So I emphasize that there was an increase of $2 million from 2017 to 2018. Now, insurance companies are going to have to make a decision. Either do they increase the rates or they continue losing more money every single year. Now, based on that scenario, that in 2017 they paid $1 million for losses, and in 2018 they paid $3 million in losses, they're going to have to make a decision, and the decision that they're going to make is that for 2019 the rates are going to increase. So as a consumer, as a customer, as a client, we are the ones that are affected financially because every single month we're going to have to pay a little bit more. But if the insurance companies don't make these adjustments, they're going to go bankrupt. Now, there's another video, another segment that we talk about going bankrupt, and I guarantee you that 99.9% of the companies that are in business today, not only in insurance, they want to stay in business. So they're going to have to find a solution. They're going to have to use a method where they could actually balance their losses to stay in business. Now, this method, this example that we use to demonstrate is a very good example because it has logic, it makes sense, and customers are able to understand based on numbers that insurance companies are going to have to increase their rates. Now, once again, in 2017, they lost $1 million. In 2018, they lost $3 million. So that's a difference of $2 million from 17 to 18. Therefore, in 2019, the rates are going to have to go higher. They're going to increase the rates to try to balance, to try to recover, to try to recuperate from the losses in 2018. And if they don't make those changes, if they don't balance their losses, most likely they're going to be in trouble, possibly even go bankrupt. So once again, when demonstrating this example, you're going to use the last 2 years and the year that we're currently in. So 2017, 2018, and 2019. You're going to emphasize that in 2017, the insurance company lost $1 million by paying for claims and losses and accidents. In 2018, they actually paid $3 million in losses. So there's an increase of $2 million. So the way it's going, based on statistics, it's going to keep going by $2 million. They're going to be in trouble. Eventually, they're going to go bankrupt. So in 2019, they have no choice but to increase the rates, a little bit higher so they can balance the losses, so they can recover from the losses from 2018, so they can maintain their business in a healthy and to be able to offer the insurance that obviously your client is requesting today. So once again, demonstrate by using the 3 years, last 2 years and the year that we're currently in, from 1 million to 3 million, a difference of 2 million, an increase of $2 million within the previous year, and therefore the current year, they have no choice but to increase the rates.